Hey soldiers, where can you keep your money in this rising interest rate environment? Now, it does look like, based on this employment data that just came out, that says that we created, the economy created 360,000 jobs. That may be an indication that Jerome Powell is going to look at this and say, you know what, we got to keep raising rates. So you want to be in a position where you're able to have your money continue to grow at the greatest extent possible. But with some of that money, you want to also expose it to less risk than it may be exposed to, say, in the stock market or in a real estate deal or what have you. Okay, fine. Prudent. However, what we need to do is take a look at what the banks are doing, and we referenced this in that previous video, what the banks are doing with regard to their ideas on what's coming in this slowdown. So they're raising liquidity. How can we raise liquidity? Simply by cutting expenses. There's something out there that we can cut and recoup probably $100, $200 a month. All right. You got to get creative. But to the extent you can do that and pad your savings, where do you put that money? Well, let's get into it. Let's talk about some places where you can put that money. Of course, you've got to do your due diligence at the end of the day, but this is just food for thought. So, look, the obvious one that comes to mind is a high yield savings account, right? We've talked about those ad nauseum. You have a plethora of high yield savings accounts to choose from. Most correspond with an online bank account, all right? We've got videos up about Marcus. We've got videos up about the American Express high yield savings account. Apple was even introducing one at one point. They ran into a little bit of difficulty, but for all you Apple devotees, look into that as well. Okay, so a high yield savings account these days, they're paying somewhere in the neighborhood of between 4 and 4.5%. Again, that's not going to beat inflation, not real inflation. But in order to keep your money liquid and have some security associated with it, then there's a price for that. There is a price associated anywhere you keep your money, all right? And this is the price here. You're going to be exposed to a return that is less than inflation, but price you have to pay, right? Everything in life is a trade-off. So we've got the high yield savings accounts out there, CDs, right? Certificates of deposits. Now, with the certificate of deposit, one thing that may conflict with its use as an emergency fund or a part of an emergency fund is that CDs are time-based deposits, in that when you sign up for one, you are agreeing to keep the money in that vehicle for a specified amount of time. Of course, if you have an emergency, you need to get the money, you may be exposing yourself to, fees that are associated with early withdrawal. Now, the CD does have its place, because after you have maybe put away 3 months of expenses for an emergency, or maybe you want to make it 4 or 5 as we sail into recessionary times. After that, you've got that liquidity. Then a 3-month CD might work well for you, because it will be around the same time frame or less than your emergency account. Now, God forbid you have to exhaust your entire emergency account, but if you have a 4-month emergency account at month 3, you've already got the ability to tap into that CD. So that's another solution that may work for you. All right, and you can find CDs out there at your bank. Talk with your bank. Some of these are returning 5%. Maybe if you keep it in there for a longer amount of time, you may get more return than that. Now, you can also look at government securities, all right? Go to treasury.gov, and you can research and read to your heart's content the different bond products that are available to the public. The I-bond comes to mind. We did a whole video on that. We're going to refresh that and do another one. Now, you might say, well, Tyrone, you're always talking about how we're in all this massive debt and, how the United States is mismanaging its money. Why would I buy a bond from the United States of America? Quite frankly, listen, if the United States goes defunct tomorrow, they just put an out of business sign on the White House, then we got bigger fish to fry in terms of our worries. So the United States of America is still viable right now from the standpoint of these short-term bonds that we can put money into to, ride any rough patch out, right? Don't worry, when the aliens invade, you're not going to have to worry about your I-bond. Trust me. The other way you can do that is there are index products out there like Fidelity's SPAC. SPAXX is the ticker symbol if you want to find out more. It's a government money market fund that has recently returned up to 4.29%. So those are some avenues that you could take. And look, let's not forget the tried and true S&P 500 index fund. Those are out there as well. Those index funds track, of course, the S&P 500. And again, these are large companies. So if we have something that affects these companies, all 500 of them at the same time, again, the best asset for you at that point would be lead, okay? I want to also remind you that those of us who have insurance policies, permanent insurance policies, we do have features within those policies that allow us to tap into the cash value under certain circumstances, and also allows us to add money to that product that we can then extract tax-free. So there are returns, there's return potential there, and there's tax benefit potential there as well. A lot of people, including myself, have insurance policies as a component of the overall opportunity/emergency fund, okay? So those are some ideas for you that you can, entertain yourself with. In the meantime, check out the video we just did talking about that situation with the banks and take a look at what they're doing. All right, guys, I'll talk to you soon.